and kick things off here. Okay. All right. I guess we've given people time to gather, and it's time to get started. I'm Steve Allen from the IAFE and from Courant Institute at NYU. I'm here to moderate and serve as discussant. So what we're going to do is first have a paper by Peter Rappaport from J.P. Morgan Securities. Then I will give a short discussion of it. Then I will moderate questions from all of you. I assure you we'll give you plenty of time to ask your questions. I want to thank first Peter for having brought his paper to our attention, and we're very, very grateful. This is part of a series that we've been doing on liquidity risk. Certainly, as ever, a hot topic these days, and Peter has a very interesting approach that we're all anxious to hear about. We're also grateful to Goldman Sachs for providing the space. I have just two messages before we kick off. One is press policy. We do invite members of the press to attend, but all comments are off the record. So if there is anybody from the press in the audience, you should ask permission from panelists afterward if there's anything you want to quote. And just note to everybody that we are recording this. We do put for IFE members, this is one of a number of recordings that is on our web page and available in video streaming for IAFE members. So just be aware that for whatever use it is to you that your questions may be recorded. Peter, do you want to start off?
Is this working? Yes? Good. Good evening. Thank you all for coming. I'm going to talk to you about something that has been a growing fascination and consternation for the last couple of years, and really came to a head recently, I would say in the last year, when most of the markets outside of equities pretty much seized up. And my perception, at least, was that the tools that people were using were simply not designed for illiquid markets. And to make matters worse, everybody had long since forgotten where they got these tools from and used them pretty automatically. I watched people trying to hedge illiquid positions, loan positions, as you'll see talk about here, and just watch it go wrong day after day and really not know what was happening, react, get whipsawed by the market, get discouraged, get demoted, and so on. And I think there's actually some system to it, but I think it raises some very, very hard questions that living in a world of liquid assets, which is where we were, believe it or not, before this last year, living in that world of liquid assets just doesn't address these questions. And I think we're going to be addressing them for the foreseeable future. So I'd like to get them out on the table. So this is working good. I'm going to try to keep my results to a very simple table that you can see not filled in here. What I'm going to be looking at is hedging a position under various different goals and conditions. And broadly, your goals are determined by your time horizon. You think of a time horizon as, I'm going to put a certain amount of capital aside, and then I'm going to close my eyes. And after my time horizon has elapsed, I'm going to open my eyes, and I'm going to hope I have enough capital for what's gone by. Capital, value at risk, they're the same thing. Okay, so what I'm going to be doing is measuring the capital that you need or the value at risk that you will experience if your time horizon is a day or if it's a quarter And I'm going to be doing that under circumstances where you have chosen your hedge to be optimal for a particular time horizon, either a day or a quarter. If you go through this rigmarole with in what I would call a liquid market, and I'll make very clear what I mean by that later on, you're going to be looking at basically prices moving all the time. There are lots of transactions. Think of public equity markets is where we're at. And from a statistical point of view, there's enough information out there, or disinformation, that price returns are a random walk on at least a daily basis. And the bottom line there is that your hedge ratio is the same whether you look at life over a quarter or over a day. And I've just standardized the value at risk number to $1 on a daily horizon. So you need, or you will have $1 of value at risk over a daily horizon if you choose your hedge optimally for a daily time horizon. And you'll have the same hedge, and so you'll have the same value at risk if you choose your hedge over a quarterly time horizon. And that's because returns are independent over time. And that's obviously a theoretical statement. You'll see it's also a pretty accurate empirical statement as well. And it just carries on being boring like that. Even if your risk management horizon is quarterly, scaled up by the number of days, the amount of value at risk you experience is going to be the same. In other words, over a quarterly time horizon, your daily value at risk, your daily average value at risk, is just the same as your one-day value at risk, irrespective of how you hedge. So life is really easy. And you can see a symptom of this, for example, if you look, as I did, in the Journal of Futures Markets, which is the home of academic papers on hedging. And certainly from the point of view of the stuff that I was searching for, they really have gone off in another direction to try to make it interesting. They're talking about Gotch models and conditional variance and so on, and none of the problems that you're going to see here. In this kind of liquid market where there are futures, for example, life is really very, very simple. As I said, long-run VAR is just scaled-up version of short-run VAR. You also get off easily looking over a long time horizon because you just use the highest frequency data to make your estimates and then scale them up accordingly. Everything's nice there. And you really don't have to confront the question of what is your risk management time horizon. So there's no real hard choices that you require, that are required of you. Now, what I'm going to call an illiquid market, you've got a different situation. Let's normalize the daily value at risk at $1. But here, we're going to have some differences because the hallmark of the illiquid markets that I'm going to be looking at is prices are stale. Prices on individual securities just tend not to move very frequently at all. For days, they can sit around and not budge. And so what's going to happen is your long-run value at risk for this daily hedge is not going to scale properly. In fact, if you take the daily average of the capital you need or the value at risk you will experience over a quarter, when you put on the optimal daily hedge, it's going to be more than twice what you thought you needed. So you hedge daily, you go through the same recipe as if you're in a liquid market, and you say, okay, daily, quarterly, it's the same thing. You close your eyes, you open them after a quarter, and you find that you're massively undercapitalized. And it's because you've taken stale prices as if they were liquid market prices. Sounds like a stupid thing to do, but as far as I can see, everybody has been doing it for a good long while. So that's one thing. Then there's a question of the hedge ratio. Well, your long-run hedge ratio is different from your short-run hedge ratio, which doesn't sound so bad, so use the long-run hedge ratio and have a good life. Well, the problem is that we live in the short run. And over a course of a day, the value at risk of this long-run hedge ratio is twice what you would get if you had the daily hedge. I'll show you examples of all of these things. So you can see you've got a bit of a quandary building here. Okay? You put on the daily hedge, you get really messed up as far as capital is concerned over the long run. You try to put on the long-term hedge and do the right thing for the long run, if you like, for your shareholders, and you're never going to get past day one because the volatility you're going to see is very high. That's the dilemma. And so you're left with a bunch of questions. Which hedge ratio do you choose? What is going to drive your capital allocation? I mean, we can mouth off about how we've got a long-term view and we're in it for shareholders and so on, but there's a sort of rubber hits the road aspect to this. Are you going to capitalize as if you're living one day at a time, or capitalize as if you're living over a quarter or a year? And how do you judge your success here? There's real problems because there happens to be a nice dovetailing of the way we risk manage over a very short time horizon and all of those principal agent things that have to do with monitoring traders, which have to be over a short time horizon as well. You cannot give a trader a fuse that's a quarter long. They have to be monitored on a daily basis. So you've got those conundrums to deal with as well. So there's a lot of hard choices here. I mean, that's laid this out sort of to my satisfaction. I hope it's given you some idea of what's going on here. I'm going to go through things in a little detail now. I'll give you an explicit comparison of hedging in liquid versus hedging in illiquid markets, how different hedges perform. I'll talk about this stale prices story and what you can do with it, and then I'll talk about the real consequences for risk management. So here's the liquid markets paradigm, liquid markets story. And I've just taken an example, granted a rather unrealistic one, where imagine you have an exposure to the NASDAQ 100 and for some reason you want to hedge it with the S&P 500. It might be that you've got a particular thing about S&P futures, but anyway, that's what you're going to use. And I've just done a little experiment here where I looked at data for the last 5.5 years, and I looked at hedge time horizons for estimating your hedge ratio of different lengths, a couple of days, 6 days, 10 days, and so on and so forth, up to a quarter. And what comes out of this is that if you just take the average of each hedge ratio at each frequency over this time period, it's roughly the same. Doesn't matter whether you're hedging over a quarterly time horizon or a daily one, the hedge ratio is around 1.2. And there's more volatility, as you'd expect, in the longer term ones over time. These are rolling samples, but it's still pretty accurate. So you get this sense that there's no need to choose a time horizon, and the long run is really just a sequence of short runs. Moving over to the illiquid market that I've at least had the most experience with, which is the leveraged loan market, I want to make a comparison between a portfolio of loans, which there I've got marked as LPC, for Loan Pricing Corporation, which is where we get the individual loan prices from every day. And this is on a portfolio of about 700 different loans. That's just the total value of the index. And what I've charted against it is the value of the high yield CDX index, viewed, if you like, as a capitalized security, as a bond. So they track each other pretty nicely too. I mean, the long-term trend is plainly the same. When you go through this same exercise with figuring out hedge ratios, though, something very weird happens. First of all, the short-term hedge ratio, the one that you get from looking at past daily data, it's around 0. And I really mean it's 0. It's not, up at 1 and down at -1. It's very close to 0 all the time, with a very small standard deviation. And as your sampling interval, how many days you're running a little regression over, goes up, the hedge ratio rises to about 0.4. But there's very, very big volatility around that 0.4. As that's an average over all the different time periods. So you don't have the same easy life here, because you've got to pick a time horizon first. And then you decide on your hedge ratio. And as you see, you're going to have to live with the consequences. So this is an explicit version of what I just mentioned in more general terms, that you can't just go hedge and be happy. There's consequences to the way you design your hedging program. And as we'll see, it all comes from the way the illiquidity works. So let me go into this stale prices business. And I should say, partly by way of disclaimer, but also because I think I think this is kind of interesting. It says something about the way our minds work in this business, and in a sense how dull we are. We looked at this market for quite a long time. The risk management people, the people on the trading floor, people doing the hedging, and we wondered why it wasn't doing the right thing, why it was so difficult to hedge it before this explanation surfaced. And I mean, I came up with this explanation, but I also sat looking at the thing for a long time without getting anywhere. And this testifies, I think, this idea that I mentioned, that we don't really have the tools for thinking about illiquid markets, and it's a whole different game. Anyway, here's the story. 700 loans over a period of about a year and a half, so you've got lots and lots of daily observations. If you put them all into one big pool and then calculate how many of them followed on a price move, how many of them were a price move on 2 successive days, how many of them had to wait 2 days for a price move, 3 days, and so on, you get this histogram of price frequency, the price change frequencies. And while there were an awful lot of these 700 times 500 price changes that occurred from one day to the next, there was also a substantial number where you waited an awful long time. 17% of the no price change periods were 20 days or more. So that's pretty dramatic. What it fits to a first approximation is a very simple model, which is just there's a constant probability on any given day of any loan having a price refresh, that is, having a trade, or not. And there's a very simple way to back that probability out of these numbers, and it comes out at about 31%. So on any given day, this data corresponds, the red line is the precise version of it, this data corresponds to the idea that on any given day, any given loan has a 3 in 10 chance of seeing a trade that causes its price to move, and a 7 in 10 chance of not moving. And that's what I mean by stale prices. And it's really pretty sobering to compare this to equity markets. And if you look across the NASDAQ 100 and S&P 500, you have a hard time finding something that traded less than about 500 round lots in any given day. Whereas here we're looking at no trade in a month of Sundays on a particular loan. So liquidity is very, very different, and it's going to matter. Let's just try to get a handle on what staleness does now to hedging. And for this, I'm going to use a very, very simple model, which is obviously unrealistic, but there's 90% of the mathematics in this picture. The idea is just assume that you have a liquid asset whose price moves every day. And then you've got a censored version of that liquid asset where before its price moves, you sort of roll a die with a 3/10 chance of coming up saying, let's see the price move, or 7/10, no price move. And when you get a price move, it jumps to where the liquid asset is, which is what you'd expect. You know, you have a loan, doesn't trade, doesn't trade, doesn't trade. All of a sudden, it comes along and trades, and all the information that you missed out gets accumulated into that 1 day's price move. So the red here is going to be the liquid asset, and the green line, I hope you can see it, is the illiquid asset. Now, in a sense, you can figure out a lot of your troubles about hedging from this picture, because you've got something that has high frequency volatility, the red line, and something that doesn't, namely the green line. Life would not be so bad if you were trying to hedge the red line with the green line. Because it's like running a regression, and you'll get big errors, but you won't get too much of a biased estimate. However, that's not the way it is. The green line is the loans, and the red line is the high-yield CDX, which is the hedge. So in econometric terms, we've got an errors in variables problem, and that drives down your hedge ratio. Just to go into that in more explicit terms, what I've done here is taken just the daily price returns of the two series and stuck them on a scatter diagram. And then I ran a regression of one on the other, and you get the regression line is the red line. And it has a slope, believe it or not, of 0.3. Why is it 0.3? Well, think about it like this. The points that lie along the horizontal axis are the days when the illiquid asset's price didn't move. And that's about 7/10 of the time. And the other ones are varying versions of it moved after 1 day, it moved after 2 days, and so on. In fact, on this picture, although this is just a random sample, you can sort of see a line traced out with a slope of 1. If your eye follows those dots, those are the days when you got it acting as if it were a liquid market. Just price change on 1 day, price change on the next day. But you've got a mixture of the two, and that's what your regression is fitting. If you move to a longer time horizon, say 3 days, obviously what's going to happen is the probability of no price change goes down, and you've got many more price change days, so the horizontal line disappears and the slope goes up. So what you can see, what you can work out from this is pretty obvious as well, which is which one of these do you want? Well, the 1 day thing is just an artifact of illiquidity. And there could be a reason for hedging like that. We'll come to that in a minute. But really you want to tend towards what the 3 day one is about. Because what you want to hedge, you would think, is the long-term relationship between the two series, which means remove the masking of the illiquidity. And that's where the big problem is, because you straight away start to get into things like, well, we should be hedging hold to maturity value. We shouldn't be hedging prices that are revealed in the market because maybe they're the result of some kind of distress. They're just the result of the most distressed buyer hitting the most advantaged seller, and that's not necessarily where we mark ourselves to. And that whole Pandora's box opens. I'm not saying I think it's a terrible thing, but you can see how you get into a completely different set of discussions because of what the simple hedging rules are doing here as compared to a liquid market. So the long-term hedge ratio in this particular simple case is obviously 1. And if you remember what came out of the actual data, we got up to about 0.4 on average on a quarterly basis. So we're a long way from it. You've got this problem that you're not going to be able to work out the long-term hedge ratio by taking long stretches of data, because they're just not going to be long enough. You've got to actually infer it from the way the illiquidity works. And you can work out this hedge ratio very easily by estimating the probability of prices refreshing and figuring out what the hedge ratio should be on the basis of that. I'm not going to go through that here. It's in the research paper, which I brought a few copies of, and you're certainly welcome to that. So that's the basic story. That's what's going on here. And that was theoretical. There are various features of the actual data of the loan, the way the loans behave, the way the other indices behave, that fit this model. One is, if you look at the loan portfolio value, its returns are serially correlated. They're correlated over time. And if you try to figure out what the correlation should be, how it moves as the lag in terms of days increases, it depends on the probability of prices refreshing. And the wobbly green line is what you get from the data. And the smooth green line is what you get from the theoretical model, where the probability of a refresh of a price is 0.3. That's loans. The other three indices have 0 serial correlation at every lag. And one can sort of moan, as I have, about, and everybody else probably, irrationality in markets and efficient markets doesn't fit that well. One of the things that I found quite interesting about this little project is it's amazing what a dividing line there is between markets where trading is patently pretty liquid and places where it really isn't. And on the liquid side is something that you might not think was really terribly liquid from the point of view of, say, how many millions of dollars you could get done each day, which is the high-yield CDX. Right? You can only trade about 25 million or so of that index without moving it a few points these days. But over the last year or so, it's in the same liquidity camp as the S&P 500 and the NASDAQ 100, and this loan index is in another game altogether. So that's one thing. Loan returns are correlated over time. They're also correlated with the high-yield CDX index if you lag the high-yield CDX. You'd expect this, right? That the CDX index, this credit default swap index, is moving every day in response to news. The loans are just not moving for a while, so they're going to incorporate past news and so be correlated with past values of the high-yield CDX. Again, there's no such correlation except contemporaneously between any other pairs of the three indices. So again, there's this divide in terms of liquidity. There's one quandary about these numbers that I should mention just by way of full disclosure, which is that peak on the green line there, that's supposed to be at a zero lag. And I know my numbers are right because I checked them like an insomniac. And I cannot get to the bottom of how Loan Pricing Corporation is reporting their numbers. Every piece of statistics seems to suggest that they are reporting them with a one-day lag, because that's their correlation with the markets. I mean, they can't have a zero contemporaneous correlation and then be correlated at a one-day lag. So here's where a little bit of sort of statistical sleuthing comes up with something quite disturbing. I can't get to the bottom of it by talking to people at LPC, and we, like everybody else, are using the numbers as if they are on the right date. So I just found that fascinating. Probably spent way too much time on it. But it shows that there is something in all the statistics, which I never really believed. So the model fits reasonably well here. And we're going to need that in a minute. Sorry. Now I've done it. I have to get back. That's it. So let's go back to our little picture and talk about risk management. Okay. As I showed you, you've got an optimal hedge ratio in this market for a short-term time horizon, for a day, and an optimal hedge ratio for a quarter. If you look at or live through their performance on a daily basis, there is an enormous difference in volatility. The green line is the P&L of the daily hedge, and the blue line is the P&L of the quarterly hedge. So you can imagine trying to justify life in blue land versus life in green land to people who run risk management and oversight. It's going to be very difficult. Why is one more volatile than the other? Well, remember, the green line is a hedge ratio of roughly zero, so it's more or less the loan index doing what it does best, which is not moving. So your volatility from day to day is very low. The other one, the blue line, is the loan index, which is pretty sleepy, minus the supercharged CDX index, which is moving all over the place, so your volatility is very high. So short term, you've got this big difference in volatility. Where do you make any headway with the long-term hedge? Well, there's all this correlation over time going on. And there's different correlation in the two cases. The daily hedge, its hedge errors are positively correlated over time. What that means is that your quarterly variance, your quarterly value at risk, or the capital you need, is going to scale up faster than if you had a random walk. You're not going to have a 1 in that thing in the top right-hand corner where I've hidden the number. You're going to have something bigger. And similarly, at least in the theoretical model, the long-run hedge has negative serial correlation in its errors, in its hedge errors, and so you're going to scale up your value at risk at a slower rate than a random walk. You're going to get less volatility. Limit there is obviously something like a riskless bond. Your volatility at a zero, the maturity is zero. So you can go to zero in that respect. So we get those two numbers that I showed you earlier, and you've got this quandary that I mentioned, which is from a long-run point of view, because of this different correlation of hedge errors, the long-term hedge works that much better. And what it says is, of course, that the capital that you need if you really looked at life on a quarterly basis and hedged quarterly and sort of closed your eyes to what went on from one day to the next, you'd need half as much capital to manage this position as if you did things religiously on a daily time horizon. This is the $1 versus the 50 cents. Okay, so I showed you some empirical results and I showed you some theoretical results. And it's kind of important where they sit in this, because they create some real practical problems for making the case here. And it sort of goes like this. These two numbers here are what you experience daily. Right? You see the volatility of your hedge returns on a daily basis, and it looks much better for the daily hedge than for the other. Okay, that's just this picture. The other two numbers, how are you ever going to see those? Well, you can't really wait. Even if you wait for a number of quarters to go by, you're not necessarily going to see that much of an improvement. And I can't actually imagine anybody in this industry waiting patiently for a few years to see what kind of standard deviation they get on their hedge errors if they put on this long-term hedge ratio. You've got to do it on faith that the model is actually right. I mean, it's actually worse than that, because if you live through 2.5 years of 10 quarters of results and you get whatever result you get, there's no guarantee that the path that you experience is going to be less volatile than the path that you see with a daily hedge. And there's no guarantee your P&L at the end will be higher or lower than with a daily hedge. All the guarantee is that if you hedged on a quarterly basis loads and loads of times and took the cross-sectional volatility versus hedged on a daily basis loads and loads of times and took the cross-sectional volatility, you'd do better in the first case than in the second case. So cross-sectional volatility of long periods of quarterly hedging is lower than cross-sectional volatility of lots of long periods of daily hedging. Of course, we're never ever going to see that. None of us is here long enough, and no one can really afford to make those experiments. So we're really going to have to take this case on faith, which makes life rather difficult. And I don't really believe that anybody is going to be implementing this anytime soon. Nevertheless, if you hedge in a liquid market, hedge in an illiquid market as if it were liquid, you come to grief in this way. There's another possibility, which is a sort of cynical halfway house you might think of adopting, which is this. And I'm sure this has come up one time or another. The story here is we mark our books to market based on prices that we get from the Loan Pricing Corporation. Okay, because our traders don't see trades, so we take everybody else's prices, which are aggregated by Loan Pricing Corporation. Of course, nobody else is seeing any trades, so the prices just stay stale. And you wonder what the logic is here. But what you're trying to do is get a sense of the market. You want a best estimate of the value of every loan in the book. So say you use this rule. If a loan trades, you take the price as gospel. Warts and all, it may be due to illiquidity, it may be a forced sale, but let's just take that price. If it doesn't trade, why don't you make the return on that asset equal to something liquid that trades, for example, the high yield CDX index? So if you follow that recipe, just every problem that I've talked about in terms of these conflicts between long run and short run, they all disappear. There's only one hedge ratio, and it's the high one. And as a consequence, there's no short-term or long-term volatility. Okay, so this would be a way of changing the way you mark so as to get rid of these conflicts. The question is this moving the goalposts? Is it sort of assuming the answer to make life easy? And I don't actually think it is. There's no real hard and fast rule for how any market prices. After I put this paper together, I gathered some information about some other markets. The commercial mortgage-backed security market actually marks individual illiquid deals in the way I just described. Most traders mark to the CMBX index, which isn't necessarily one of the most liquid market benchmarks around, but it's there. In the ABS market, they act like the leveraged loan market. Namely, they're only going to mark their books when a trade comes along. And so there are no rules. You get the impression that pricing rules are conventional. Where did this come from? Well, it came from traders really only caring about credit events. I mean, there's something very weird about not moving prices in this day and age on a fixed income instrument when the yield curve moves every day, which means that the present value of the cash flows changes every day, but the price of the loan just carries on at $97.50. Well, those were the good old days, but it just carries on at the same price every day. They're only looking for credit events. So my personal view is that they're just not so golden. And it might just be easier from the point of view of getting the right capital allocation to try to find a better signal of where to value illiquids by going to something liquid. So just to summarize, we've got a story that works nicely in liquid markets. Everything is pretty easy. No conflicts between long run and short run. And that's where everybody sort of cut their teeth. That's where everybody learned how to do this stuff and promptly forgot where the lessons were and just did it on muscle memory or whatever people call it. And then suddenly life got pretty volatile in illiquid markets, and we had to hedge things in those markets. And it got very difficult because it gives you very different signals, and you have different hedge ratios at different time horizons, and you can really mess yourself up in the following way. If you design your hedges to work on a daily basis, your capital allocation is going to come to grief over the long term. And the long term is your real goal. Our documents about the way we risk manage, other banks that I've seen say that we may do our calculations on a high frequency, but our goals are long term, and we're extrapolating from one to the other. You can put on the long term hedge, but it's just very hard to stomach. In the short run, what you're really after is this figure in the bottom right, but it's practically impossible to see it in anybody's lifetime. So really, if you're going to go with this, you need to choose a time horizon, and you need to live with its fallout at the other time horizon, and that's not particularly easy. So this is the sordid world of trying to hedge in the illiquid markets that we're seeing these days, and I thank you for your time.
Peter, thank you very much. I'm going to start with a few comments before throwing it open to everyone for questions. And maybe, Peter, I'll give you, after I make my few comments, I'll give you a chance to respond if you want. In making my comments, I'm going to kind of sort of temporarily try to put on one of my former hats of my prior career, and as a risk manager, as in fact head of risk methodology. As it happens, it was at J.P. Morgan Chase, though I don't think there's anything unique about that. And there are two things that I can see in my experience that are analogies to this that I think would possibly be, open the way to have risk managers look at this in the way that Peter, I think, very sensibly is asking us to. The first is that we always, for a long time, recognized a problem of asynchronous data. We would have data being quoted, let's say, in a market that closed at the closing time for Tokyo, the Tokyo closing time, other markets at the London closing time, other markets at the U.S. closing time. Even within the U.S., you might have some markets that closed as of the closing time for the futures market, and others that closed at a closing time for the cash markets. If you used the actual prices at the end of the day for each of those markets and used that as your input to evaluate risk calculation, you would get things that were clearly not accurate. They clearly had hedge. They clearly would recognize as having risk positions that had considerably smaller risk, because it was just risk that was being picked up from the difference in time period. And a classic solution to that was often used, particularly if you were using Monte Carlo simulation to do your value at risk, was to calculate your correlation coefficients over longer time periods. If you did your correlation coefficient over a 5-day period rather than daily, it would give you much more reasonable values, because a lot of this asynchronous effect would get washed out as you looked at longer periods. This is something of the same phenomenon. I mean, here the asynchronous effect isn't coming from different closing times, but it's coming from the fact that some markets are sort of continuously open or open on a daily basis. Others are only reporting on a less than frequently than daily basis. It creates a bit more of a problem if you're doing historical. You're doing your value at risk through historical simulation, because now you've got to basically create a time series that matches up. But there are methodologies for doing that. The second analogy that I would take to things that I saw in my experience and that were accepted practices within market risk was that traders in doing their mark-to-market would say, well, I feel that we don't have a legitimate mark-to-market here. We're getting a quote, but it seems like a stale quote. Can I move my quote for the fact that I've seen other markets move that are related markets that are more liquid? And that was something that in doing model reviews, would accept, and I think was a reasonable thing to accept as something that brought pricing more closely into line with reality, though there always had to be a testing, an ongoing testing to see that it was producing reasonable results. The one caveat, though, that I think is very important if you use either of these methods is to recognize if your pricing, if your need to change the way you're recognizing your pricing, change the period that you're doing your correlations, is being caused by price illiquidity, that price illiquidity needs to get reflected in your risk capital. Your risk, so in other words, risk capital can't just be a fixed thing, like we're taking risk capital over for a daily period and then scaling it up by some square root of time. If you've got a series, if you've got a price, an instrument whose prices are less liquid, you have more risk when you're seeking to exit that position. And that risk in exiting the position needs to get reflected whether it's in capital or it's in reserves or it's in limits or a combination of all three, but that illiquidity needs to get reflected in your risk management. And so even if you're using, let's say, a daily value at risk and then scaling it up, I mean, I'll just use the Basel standard, we take daily value at risk and scale it up by square root of 10 times this arbitrary factor of 3. That's fine for liquid instruments, but if something is illiquid, if it can't truly be exited over a one-day period, either because of the instrument itself or because of you're having a very large position that it will take you time to get out of, you've got to use a longer time period in coming up with the capital or reserves that are needed against that position. But other than that, I think it's very reasonable to use a model that reflects a greater reality in terms of how the prices are related.
Okay. I won't say much because I've said plenty, and probably other people want to say something. But I think that the last thing you brought up about the issue of whether you should mark, whether it's a greater evil to try to deal with illiquid prices or to mark to model, is it's just one of the big alarm bells these days. And I would say, I mean, just from what you see in the press, there's almost a religious fervor around taking market prices, whatever they are, rather than superimposing something that comes in-house, or even trying to come up with some sort of market-wide valuation committee that would be in the place of a market. And I think that the more that we move in that direction, the more we act as if it doesn't matter whose laundry it is as long as it's not ours. I mean, the price can have no real depth to it, and as long as it comes from outside, it's golden, and if it comes from inside, it's not. I think we're asking for trouble, although the trouble is rather subtle, and it comes, in terms you were talking about, it comes in the form of just not utilizing capital very effectively and getting some rude surprises. So I think that is the crux of it, because the answer is ultimately, as I showed in the second to last slide, to be prepared to go with some sort of mark to model.
Right. Why don't we start taking questions?
I was interested in that comment you made about replacing on days when you don't have moves, replacing with some index move. And I was wondering that the way I understood you said it was you just replaced it just outright with the index move. And I was wondering if you didn't have, if that was the only index, assuming that's your universe, to what extent would you be willing to consider, in some sense, tweaking that with the past correlations between those two instruments, between the index and the instrument, rather than just taking the index move itself?
I think the way you describe it is the way to go. Ultimately, you have a beta, if you like, of the asset that you're trying to track the unobserved price value of against the market, and your best guess in the absence of a price for the asset is beta times the move in the market. The devil is in estimating the beta, but there's obvious ways to go about that. You can have an average over all of the things that actually have moved. There's no reason to believe that the illiquid loans are really that different from the liquid ones, or at least you don't have any reason to believe there's a bias. So it would be of that form.
Yes.
So, can you estimate the hedging ratio based on, say, that can measure the long-term relationship?
Sorry, is there a microphone you can talk into?
Yep. So can you estimate the hedging ratio based on co-integration? Supposedly, that can measure the long-term relationship between indices, or the index and your loan.
That's interesting you bring that up, because that was actually my first way of going about this, to look at the idea that, well, if there's a long-term relationship, these things are somehow glued together, and so obviously they're co-integrated, so I should just estimate the co-integrating relationship. And of course the great thing about that is that it's a very precise estimate. You know, it's super consistent and so on. And you know, the thing, you get the right answer, as it were, in this particular case. But if you want to get if you want to get really precise about it, it doesn't really work in the following sense. And this is one of the things that I think is kind of wrong with the co-integration literature, which is a rather sweeping statement to make. So let me qualify it. The whole story about co-integration is you have one sort of random walkie type of series over here and another one over here, and their non-stationary pieces are common. They can't have anything else that's non-stationary, right? So they can have stationary bits, but the non-stationary stuff has to be shared 100%. That's effectively the definition of co-integration. Now, think of the sort of the standard capital asset pricing model that is behind just about everything. For example, it's behind all this Gaussian copula stuff that we use in credit markets, in the sense that you have a market shock. Returns are made out of each asset are made out of a market shock and an idiosyncratic shock, right? And so what we want to do is say the market shocks are obviously correlated, and then there's this idiosyncratic stuff that is not necessarily correlated between, say, the loans and the high-yield CDX index. So they share a market shock, they don't share necessarily some idiosyncratic piece. The problem is that the idiosyncratic thing is also a non-stationary series. So, and that's not shared. So the co-integration game doesn't really work here. And I find it very unsatisfactory, because the intuition is obviously, well, you've got a sort of big random walk thing, a big non-stationary piece that is shared between the two markets, and then you've got this sort of small non-stationary thing, which is the average of all the idiosyncratic pieces, and okay, it's not shared, but over anybody's reasonable lifetime it's not going to be a big deal. But all of the results that you would use to make sure you've made the right inferences rely on there only being shared non-stationary pieces and no non-stationary components that are not shared. So for that reason, it doesn't, strictly speaking, work. And there's some stuff on co-integration again in the futures hedging papers that I looked at, and their story relies on there being just sort of one shared random walk. So intuitively, I think it's the right idea. Unfortunately, all the sort of theoretical results don't actually underpin the very model you'd like to use, which is signal plus noise. Anything else?
Given that the loan market has only been around and the indices available for, say, about 10, 12 years, and the liquidity has evolved significantly over that time, and the volatility has increased and behaved so uncharacteristically over this year in particular. How do you kind of evaluate the recent volatility in the context of how you would hedge a loan portfolio over the longer term? Do you include this recent volatility, or do you consider it an outlier?
That's a very interesting question, because ultimately it sort of translates into how do you keep risk management separate from taking a market view. And it's very difficult in an environment where you don't think anything that you need to estimate to drive your hedge, you can estimate it at all precisely. And so you're ultimately taking a view on that, and there's precious little difference between that and a trading view, a directional view. I think ultimately it boils down to something along the lines of whatever illiquidity is driving prices in the loan market, it's doing the same thing to the thing you're hedging with. And it's a cop-out. It's in the sense that, that's the answer that keeps you sort of on the risk management side of the fence as opposed to the view-taking side of the fence. And that's really the only way I can think of staying there, which is, just to repeat it, that the illiquidity is across the board in your hedge and in the thing you're trying to hedge. If that's not the case, if you put any kind of probability on that not being the case, then you really have moved into taking proprietary positions. And I don't think that's a terribly bad thing. And I think actually the idea that you can separate risk management from taking proprietary positions is another one of these luxuries of operating in treasury markets or markets where there is very deep futures contracts and so on, and you can hedge every tiny movement without paying any transactions costs, without worrying about quality of data and so on. I think, as I've said earlier, we grew up on those markets and those techniques, and it always comes as a very rude surprise when there's some other market that it doesn't fit. And I think the circumstance you brought up is an example of that. And I think in an illiquid market, the distinction between risk management and taking a view or proprietary positioning is artificial. So I don't have a good answer.
Would you have a different approach if you looked at the hedging on a single name fundamental basis?
What would you hedge with, for example?
Short the bonds versus long the loan, or something like that. That's a really difficult one, because I think that gets you into the world of, well, when they go bust, just this company, how far are they going to go bust? And from way back, one has always got to be impressed with how uncertain recovery rates are. And it always strikes me as an absurd thing that the one thing you can get away with in modeling in credit is recovery rates. It's you put down your bond CDS recovery rate as 40 cents on the dollar, no one argues with you. For subordinate, it's 25 cents, and for leveraged loans, it's 70 cents. And it's as if these things were handed down from Ararat. These numbers are all over the place, and I think people were very surprised by what happened with Lehman, for example, that you came back with 9 cents. But it should not be a big surprise that recovery rates are incredibly uncertain, because as soon as the company is going bust, there's all sorts of things that are thrown overboard in an attempt to stop it from going bust. And it just becomes very, very volatile. And I think ultimately that fundamentals hedge is about what's going to happen in it's like the opposite of the Big Bang. It's what's going to happen in the last 5 minutes of the company's life. And I'm not entirely sure that that's something that's very easy to predict. So I'm not very sanguine about those hedges as a hedge of recovery rates. They work wonderfully when the company's sound. They're very, very solid, but you don't really want to put them on when the company's sound unless you think there's some serious mispricing.
In the back there?
Hi. So you had mentioned a couple of examples. I know there were just examples, but where you would hedge with something that wasn't exactly the same index, or hedge with something slightly different. Now, how damaging would new policies be? I know they're talking about certain new policies where you couldn't, say, buy a CDS unless you own the underlying reference asset. How damaging would such a policy be to programs like yours?
I think it'd be a disaster. I mean, to just hedging in this. I mean, this is basically proxy hedging, right? There's, if you like, accountants hedging. You know, there's the way the FASB rules work, for example, where you've got what is the terminology? You've got a highly effective hedge. And a highly effective hedge is basically something with the same DNA as the thing you're trying to hedge, like what you're talking about. And then there's statistical hedging. And I mean, my own personal view is that we're in a statistical business. The finance sector is supposed to be a statistical business, and you know, it's a bit like the insurance industry being regulated in the way that you're describing. You know, where they have to go back to me to sort of buy life insurance back when they've sold me life insurance, or else they don't get hedge accounting treatment. I just don't think it. I think it would put a real crimp in any argument that was to say that we're actually doing some economically efficient reallocation of risk. If you can't do it on a statistical basis, I don't think it's worth doing it at all. Is that what is that the kind of thing you're referring to? What's your view?
I was just shocked when that proposal was even made. I don't know if it's being made by someone who knows what they're talking about, or just someone from outside. Yeah. I mean, agree with you fully. Yeah.
There are rules on the books as far as accounting recognition of hedges goes that sound very much like it.
I think one of the problems at the moment is that we've got these statistics out there that are saying that the amount of credit default swaps that are hedges that exist, or the amount of credit default swaps in existence, is multiples of 10 or 20 times the total amount of credit outstanding, and there's very little understanding of the degree to which that's due to just completely matched trades, where the only there's no position anymore. It's simply a counterparty credit risk position, and I think there's going to have to be, there's probably going to have to be a huge reduction in the amount of that trading in any case, because of the kinds of issues that we've gotten into with Lehman and AIG. But even after we reduce it, there's going to have to be a much better education program tried, because clearly the people who are trying to regulate this now a lot of them do not really understand. And certainly the public and journalists do not understand where these figures are coming from.
Can I just, since we've got you all here, this is just a question that fascinates me. You hear this number. I mean, you hear it almost as frequently as you hear the name Bill Ayers. $62 trillion of credit default swaps outstanding. And I guess the question is, we know that a lot of those trades are simply, rather than unwind an existing trade, you do an offsetting trade either with the same counterparty or with someone else. If all the obvious netting were done, so that we just got down to the minimum amount of counterparty risk that's actually there economically rather than contractually, how much do you think the total number will go down? Who thinks it's more than 6 trillion?
There is statistics. Like recently, there was a run of the serious portfolio compression on certain software companies. They reduced the amount outstanding by 50%.
On those companies?
Yes.
So you'd say, based on that, there's 30 trillion outstanding.
Just based on matching of cash flows of different, companies on those CDSs, and issuing the compensating trades. 50% is statistics.
So is that a lot, 30 trillion?
Still a lot.
I don't know. I think it's a hard one to get a grip on.
In this, portfolio compression. It's about 12 companies, but major players.
Sorry.
Over in the corner there.
I'm for DTCC, so basically the CDS the solution to DTCC.
Hi, could you turn your microphone on? It's hard to hear you.
So we have like the internal release of the CDS. The position is around like the $39 billion. So it's because we are the warehouse for the CDS, the global warehouse for the CDS transaction. So our number shows it's like around the 39 trillion.
39 trillion.
Billion, sorry.
Billion.
Yes.
Well, I guess it should be economically, it should be like kind of close to whatever the underlying bond you have, because that's the insurance on the bond, right? So that's the maximum you can do.
No, because it's
Out of air.
You don't have to have the laws that create the CDS. The original business started out that way. If you look at one and a half bucks and then created CDS to get out of the place. But after that, people just created CDS for that long because they're running the magic book. I guess in large part, it should also depend on
switch your
what you
microphone on.
consider. It should also depend on what you consider an offset, right? Does it have to be notional against notional per time period? Because there are mismatches in time as the CDS rolls down, right? There's a 5-year maturity initially, but it starts to roll down. And when you put the hedge on or you take the offset, you might roll into a 3-year CDS, but the roll down on the existing one might only be 2.5 years left, right? So what do you consider an offset?
Well, I think what I was hoping to hear, because I don't know the answer to this, but I mean, I know what the answer looks like, but I don't know what the figures are. Your figure was very interesting, if sobering. First of all, I think just about everybody who's not a dealer has to post margin against trades, and so most of the counterparty risk that's not inter-dealer nets out. And then there's netting of inter-dealer trades. So I don't know. My sense is that it's certainly much smaller than that number. But someone needs to do a better job of just figuring out what it is. Because it's a matter of time before we hear about weapons of mass destruction again. And for all I know, it may be right.
Could you turn your mic on?
Getting back to the root question of the ratio between, or potentially unlimited ratio of CDS action that can be written on an underlying credit, do you see that potentially infinite ratio as being problematic in a conceptual sense? Should it be possible? If they all netted out to zero, would the possibility of that kind of action be a problem for you?
I should mention that this is my own view and so on. I think the only time when it gets to be potentially a problem is if you're not doing this across an exchange. I mean, if you're doing this through a clearinghouse, I don't really see any issue. And you would expect if there is an excess demand or an excess supply, prices are going to move and have some sort of corrective action. Although there can obviously be bubbles that speak against that. But I think the place where it gets worrisome is that it's of the nature of an OTC market that it's hard to track. When it's small, there's a very good reason for it being an OTC market because it costs an awful lot to run an exchange. However, when it gets to be very large, it gets to be a pain for most people. I mean, you talk to most of the conversations about default swaps have not been about credit recently. They've been about clearing and backlogs and operational drag on profitability and so on. And I mean, I think we're probably moving towards an exchange, and I think what the exchange does as a clearinghouse is to, as far as I can see, to short circuit that worry. I mean, we haven't really had any kind of any kind of futures market problems in the same way as you had problems in unregulated position taking on future values of commodities, for example. I mean, I'm no expert on that subject, but it seems to me that massively growing over the counter markets it's just a funny way for us to go. Let's put it that way. It's something that's probably outlived its usefulness.
But just as a reminder, there is a law in the United States that makes it illegal to have an exchange-traded future on onions, because the onion farmers got very angry, and even exchange-traded, I would expect that there's going to be a demand, just as there's anger at short sellers at the moment. There's going to be anger at people who want to benefit from taking bets against the creditworthiness of firms. I think that'll be there whether it's exchange traded or over the counter.
Mm-hmm. I mean, I think that's I guess another reason for moving to exchange traded is the game is up in a sense. The bid-offer spread on individual default swaps is incredibly narrow, given that we're in a time of illiquidity. I mean, if you had told someone 6 years ago that we were going to get into very deep water, people were going to start talking about the Great Depression, and nevertheless you would be able to trade the credit of companies at a 3 or 4 bid-offer spread on a bad day, they would have thought you're insane. I mean, the liquidity that it's created is really quite remarkable compared to the bond market. And bond markets, corporate bond markets, were a pretty funky place. There was a time not so long ago where Ford was the most important bond around because it was the cheapest way to take a duration position if you were an investment-grade money manager. And it's to the credit of the CDS market that all that nonsense has gone by the wayside. Other things have come up, but I think they're mainly that the CDS market has grown out of its original form, not that it's a bad thing to take bets on.
In the back.
Yeah, I agree that the spreads have basically matched up along dealers, and it's been pretty liquid. But how are you going to deal with the basis risk and documentation? Because all it is, there's a one-off. They're negotiated counterparty by counterparty against the dealers. The original CDSs had physical delivery versus cash settle, things like that. There's a lot of issues with standardization of the product first.
Yeah, I agree with you. I mean, when on the Lehman default, we had a whole menagerie of different swaps to settle, and I don't think it's any secret that some of them are still being negotiated because the rules proved to be not clear. The written rules proved not to be clear enough to figure out what on earth to do in the event of a default. But the sort of the dealer poll version or the auction version of cash settlement seems to work in most cases. I mean, I think the important thing is to get one set of rules, even more important than there being a particularly wonderful or last-ditch set of rules. But I agree with you that you look at whatever's in that 62 trillion and there's an awful lot of hair on it, and I think it would be one of the benefits of having a clearinghouse market that with it comes standardization.
Yes.
Hello. I have two questions about illiquid CDSs, basically the ones which trade like once a week or less, and the regulation I've seen proposed in the media. So one regulation I've seen proposed is that all CDS trades would be reported to a system similar to Trace for bonds. So basically you trade something and everyone can see it. And the effect of that would be, if something is traded at a certain spread, and then 5 days later the market has moved quite a bit, but you still would have to probably market and hedge it at the very stale price. What would you do? Kind of, is the approach you proposed where you would adjust that last stale price by some kind of a benchmark allowed? Okay. And my second question is, do you think there would be more liquidity in names like this if, like with equities, dealers were required to just publish a bid offer on CDS and perhaps on recovery swaps?
So you're talking about really a sort of exchange-traded CD. You're talking about a format for CDS like the New York Stock Exchange? Is that...
Basically, I was just reading in the media what the various people proposed to do with CDSs. So one proposal was that anytime a CDS is traded, like there's a trace for bonds.
I can't understand what you're saying. Don't talk into the microphone.
There is a system called Trace for bonds. So if you trade a fairly liquid bond, you can look it up in some system and see where it was last traded, even though it's not on an exchange.
I'm not really familiar with this. I'm sorry.
Okay.
I think what he's getting at is
you're
trace
saying
reporting.
What would be the impact of, moving from the trace system where now we report the prices at which bonds are exchanged, to do that the same thing for CDSs.
Right. Really good news.
So if we brought the same kind of transparency to CDSs to bonds, of course I think CDSs already have. I think Trace was an attempt to bring the same kind of transparency to bonds as we already had for CDSs, because CDSs trade fairly liquidly.
In a way. You got half of one and half of the other. It's like what we were just discussing before. You have more clarity in pricing with Trace for bonds, and bonds sort of take care of themselves when it comes to recovery because there's only physical delivery. With CDS, you have a very simple contract, and then the wheels sometimes come off when you actually move to recovery. So I don't know that the CDS would benefit that much from a trace type system. I don't really see the relevance of it.
The point is, many names in something like market don't trade very often. So the spread that you see on market might reflect better where you might trade it now than the last trade which was done perhaps a week ago.
So you're saying market actually moves prices to reflect?
Yeah, market shows where people say they might possibly trade it.
I see.
Yeah, it's not actually where it was last traded.
I'm not a big fan of that. I think it's very, very hard to exercise quality control, and it's probably better to do it yourself. In other words, if I were a consumer of what market provides, I'd rather they give me the raw information, and then I'd prefer to process it myself rather than have something that they've processed. Now that's an answer that is, in a sense, from a risk management point of view, it's a little bit politically incorrect, because there's another. I guess there's another tradition that says as long as it's from outside the house, it's good. And what you're doing is saying, well, I'm going to take some stuff from outside the house, then I'm going to layer my own stuff on top of it. And I'm more of a fan of that. But I can see how, for some people, it might be a more airtight way of doing risk management to have market do that processing for them. So I think that's the issue. It's by no means that, you know, if you're a big company you should do it yourself, and if you're a small company you should take it from them. It's a question of where you want to take your operational risks, in a sense.
Right. Let's have one last question, and then we can continue less formally over refreshments. Anyone for a last question? If not, then thank you all very much. It's a very lively conversation, and thank you once again, Peter.